Ticker symbol ISRG is up around 85% in the past year, and today we'll be looking at an established leader with revolutionary technology, which has incredible growth potential. In the past year only, its net income has grown by above 48%, and it even had consecutive quarters with net margin expansion. Today, we'll be looking at Intuitive Surgical, a medical devices technology company. Now, in their annual report, they say that they envision a future of care that is less invasive and profoundly better, where diseases are identified earlier and treated faster. Now, before we jump in, I just have to say that when I did a quick analysis on this company, I actually fell in love and I wanted to buy it so bad. But let's see what this company actually does. So ISRG is committed to advancing minimally invasive care through systems, instruments, and services which enables actionable digital insights. So they're a revolutionary tech health company where they have these devices, such as the one that you're seeing on the screen, that are extremely digital, and they're all connected in order to rack up so much data about the patients, about the proceedings, and about everything else that it allows hospitals to act a lot better, learn from their mistakes, and even keep insane track records of client profiles and just improve the offering and the effectiveness of procedures by a lot. So they divide their offerings into three different categories. The first one being, of course, systems, which are, as we're seeing on the screen, robotic systems that provide precise, powerful systems which allow minimally invasive care. This not only increases the chances of survival, the chances of success, but they even provide a less hurtful and easier rehabilitation process. They then have the instrument segment, which are some machines that transform the surgeon's hand movements into micro movements, and they even filter out natural hand tremor. So for example, if a doctor is doing a surgery and they move their hand 10 centimeters, the machine has a setting where this 10 centimeter move from the doctor's hand translate into, for example, a 10 millimeter move from the machine. So this increases precision and also improves the efficiency of the operation and increases chances of survival. And finally, they offer digital solutions, which are then the cloud-based connector offerings, which allow to streamline performance for hospitals with program-enhancing insights. Now, when we look at their financial analysis, it looks amazing. They have a return on capital employed of 15%, which is just around the threshold that we usually look for. They have an interest coverage ratio of above 100 times. Basically, they don't have to worry about debt anytime soon. And they have a cash conversion rate of around 41%, with a profit margin of 67% and a great operating margin of 29%, where our usual threshold is also around 15%. One thing that I would try to improve here is their cash conversion, because we like companies that are great at generating free cash flow. Now, I've said it before, I'll say it again, their growth is impressive, and I believe that these products have such a high growth potential, as we can see that their net income has increased by 48%, and there has not been a single quarter that their revenue, gross profit, or net income have not improved. Adding to this, their net margin has been expanding, which allows that net income to grow at a faster rate than the revenue. Now, of course, this has a very direct effect on the efficiency ratios, which have been improving over the past years. Now, the return on invested capital is sitting at above 20%, which is great considering a company which had a return on capital employed of 15%. And one thing that I love about this company is their use of leverage. They barely use any, which makes them look a lot more attractive to investors, but also decreases their chances of bankruptcy almost to zero. So this is very positive for ISRG. And now when looking at their fundamental analysis, they get a very solid 6 out of 8 ticks, as they have very low liability risk, they have an extremely solid balance sheet, which means that they can pay all of their current or short-term liabilities with their current assets, and they're great at their consistent cash flows. Additionally, this company is able to grow their revenues organically, meaning that they don't need to rely on acquisitions in order to grow their revenues. But the most important factors from this slide, I would say, are their pricing power and their existing moat or competitive advantage. Starting with their pricing power, I will divide it into two different sections. First one, their offerings, which are their machines, robotics, and all the accessories. And second, their cloud-based solutions, which is the way they digitalize hospitals. These products are very unique, and it is very hard to find a supplier that can actually match the quality that Intuitive Surgical is actually giving. Additionally, since these products are patented, it would be extremely rare for you to find something vaguely similar to what they're offering. Due to this, a lot of hospitals are willing to buy this regardless of the price, just because it increases by so much the chances of survival of the different patients and their ability of actually conducting way harder procedures than if they didn't have the support from these machines. And the second aspect is a subscription-based solution, which allows to keep all these hospitals on their backlog and increase their prices from year to year above inflation without losing their customers. Because this has very high switching costs, meaning that if hospitals would want to switch from ISRG to a different supplier, they would have to pay for a full project to just transform all of their information, which they will not do unless they have had a big problem with ISRG, which has not been the case so far. And now regarding their existing moat, what else do I have to say than this company has a portfolio full of patents which expire very long into the future. Now this protects them, which allows them to have the most pure form of competitive advantage. The two things that I didn't like though is that this company is not using their free cash flow to pay out dividends or to buy back their shares, and that this company is not able to grow their free cash flow organically. So that is a point that I would like this company to work on. Now, when we look at their valuation analysis, it is clear that this company would be trading at very high multiples. As we can see, currently it is trading way above its average for the past 3 years at above 80 times their earnings. Now, additionally, their free cash flow yield is 0.3%, which is way beneath the 3% long-term inflation rate, also suggesting that this company is extremely overvalued. And now the only two risks and possible challenges that I see if I get too picky with this stock is, first of all, performance or not meeting performance objectives, and this is looking at the stock. I always say this, when companies trade at such high valuations, any slip up that you have or any quarter that you might not beat expectations, the stock will tank big time. Just look at when this has happened with Salesforce, when it has happened with Facebook, or when it has happened with hundreds of other companies in the past. And now the second risk that I see is the market risk, where since these machines are so expensive, I can see hospitals not actually willing to buy these whenever there is an economic downturn. Now, before we move on, please remember that I'm not a financial advisor and this is not financial advice, so please do your own due diligence. However, I believe that this company has a very strong competitive advantage. It provides consistent cash flows and it has high return on capital employed. So I believe that this is a good company and I would love to own it. However, it has high valuations, it is issuing shares at a higher rate, and I would like it to become better at generating free cash flows. Having said that, thank you for watching. As always, this has been the Cashflow Compounder. Please join the free Patreon for extra content, and I'll see you in the next one.